Ryan Pickford. What's
John,
up?
what's going on, dude? Good to see you.
Good to see you. Yeah, we've been working with you guys, I think, the entire time, right? Like since we've been open, maybe a
That's
year.
correct.
So
Yeah,
extra.
we were here with you guys, I think really from the infancy of whiteboard. 2015, 2016. Um, you guys had this vision, you, Dallas, Jen, and Jeff. And I mean, to be honest, I don't know if we were quite sure where it was going to go, but
Samesies.
you guys were definitely enthusiastic about it. And fast forward, and it's definitely uh, picked up plenty of steam, and I think here to stay. So it's been a fun ride to just be a small part of it.
Yeah, absolutely. Well, not really a small part of it, man. Like we greatly value your partnership. We've worked with quite a few wholesale brokers, and they're notoriously bad to work with. So like we're very thankful for you and your team, and I'm really impressed with how you guys can come alongside us and help us. So with that being said, Brian, would you mind kind of giving your background, your company, and what you do?
Yeah, of course. So I joined up with CRC in Redondo Beach in 2015. Prior to working for that office, I worked as a wholesale broker for a smaller kind of niche excess broker in Orange County, and did that for 3 years. Kind of one thing led to the next. The team in Redondo was looking to grow. I was looking to kind of join up with a larger firm that seemed like at that point in time, as a wholesaler, you needed to aggregate markets, aggregate scale, kind of be one of the bigger players if you wanted to go and work on larger accounts. So I joined up with Evan Aldrich. That's who I report to. And really my focus is casualty. So that is GL, excess, environmental, largely construction focused, but for you guys, we see a large range of risks.
Sure.
We could probably have a whole podcast on all the stuff that you guys send us.
I would imagine.
Yeah, but yeah, that's it in a nutshell. When I joined the team, there were 4 of us in total on Evan's team, and now it's eight years in for me. It's grown substantially. It's been a really fun, exciting ride, double-digit growth year over year.
That's amazing.
For 8 years consecutively. So, right now it's we've been able to ride the wave of a challenging casualty market, and be in the right places with the right retail brokers at the right time. So that's what I credit a lot of the growth to.
It is a crazy market right now. I mean, this has been a wild ride. Do you see it slowing down at all?
Well, from a liability standpoint, excess especially is not as hard as it was, 12, 24 months ago.
Sure.
I think there's definitely pockets where it's softening substantially. If it's I mainly write, practice policies, with some exceptions to that. But if you're a commercial contractor in California, or really anywhere with the exception of a few states, the retail direct admitted markets are coming back into the fold. They're able to quote packages that maybe they were turning down in recent memory. So it's not, as dire as it once was. I would say that it's important to sort out, which of those new capacity markets are valid and which ones may not be here for the long haul.
That makes sense.
So
regards to like the excess is probably like the gnarliest line, at least we saw on our side. Is that entirely driven by auto, or is there more to the story.
Yeah, that's the main culprit for sure. Auto is the loss leader. And that, what was once a severity incident, is now magnified with all of the social inflation, real inflation, things that are economically driving claims costs. So yes, from an excess standpoint, it's largely auto.
Is that mostly in California, like with like the new topics, or is it all over the country?
It's a nationwide. Yeah, it's the venues. There's certain counties across the country that are notoriously tough. So we're all well aware on our side of like what that landscape looks like. Not only from a construction defect standpoint or a liquor standpoint, but also an auto standpoint, which territories are causing or finding the largest, nuclear verdicts. What I tell people is that it might be the first time in my career that it's almost a disadvantage to be an incumbent, because you've got a target on your back. You may be handcuffed to rate guidelines that other markets that are seeing the account as new business are, they're free to price it however they see fit in the non-admitted world. So it's just something that we have to keep an eye on. We have to educate our clients as to what else is out there, and allow them to make a business decision that they see is best for them.
Sure. This might be outside your scope of like obviously what you guys do. But when it comes to like the property market, maybe in work comp, are you seeing like you catching any wind of what's going to be happening there at all?
Property's upside down. Not my focus, but with wildfire, predominantly in the Western United States, it's not just a California problem. There's wildfires all through Colorado, Idaho,
Sure.
Washington, Oregon. So it's all through the headlines. Everyone knows about it. And so I kind of hear the ripple effect of what that looks like, all the relayering that has to take place on a property account, incumbents non-renewing, risks that maybe haven't even had large losses, just are in the wrong
area.
Right. So the challenge is that liability hasn't exactly been, it's had its, a string of years where it was, the way that we kind of explain it is that you can't pay today's claims in yesterday's dollars. And so a lot of the casualty losses were underfunded. The rates were too low. And then we're seeing lift for that reason. And that's all predicated on, reinsurance as well.
Yeah. It is it feels like there's obviously this all gets passed to the consumer, ultimately it's where it ends up. And it feels like there's so many like externalities beyond just like increasing like rates with like inflation and cost of goods going up, like raw materials. There's so much pressure, especially on here in California. A lot of our clients are getting hammered.
Yeah, it's a tough time and place to run a business. I think for all the things that you pointed out, it doesn't take an insurance genius to see the publications that are out there that are talking about, if you're a contractor, all of those factors are kind of pointed against you. And then on top of that, you're getting hit with year-over-year increases on your insurance, yet you may not have paid any losses. So that's, I feel for, the buyers, the policyholders that are met with those challenges.
Yeah, that would be frustrating. We've had to deliver a few double-digit rate increases. Like I've never had a claim on this.
Right.
Why is this happening? It's like a really frustrating position to be in for, I think, all parties. Like, hey, it's grouped together and this is what happens. What are some things, I guess, like for our clients who might be listening in on this, is like, from your perspective, when you're submitting an account to like your markets, what are some things that our clients can be looking out for to make sure that that application that goes in is like top tier?
Yeah, we try to do our best to front load information, quality information at time of submission.
Yeah.
And ideally 60 to 90 days out, we have everything ducks in a row, in terms of applications, loss history, if there have been claims, mitigation measures that the insured has taken to make sure it doesn't happen again.
Yeah. I'd
I
imagine
think,
on the access, like you guys are looking at the auto very closely. So someone's got a fleet of 100 vehicles. Like, what are those best practices that you guys like to see?
so fleet breakout is kind of the first question that we're asked, confirmation of how many light trucks, medium trucks, heavy trucks. Like, if unit count doesn't really do us much good if we don't know what those units are right. So that the radius of operations, total mileage, historical fleet count, things like that, that help not only round out the exposure for what we have projected for next year, but also what's taken place in the last 3, 4, 5 years that allow an underwriter to feel comfortable that this is a stable fleet, and that it's not something that's going up or down in one direction significantly. The last thing you want to do as an excess underwriter, because a lot of our policies, the vast majority of our excess deals are non-auditable. So unlike GL, where there's a rate usually with revenues, and then if you're, if the insured under projects, then you just capture that increase at audit. If you're an excess underwriter, you can be upside down if you don't properly account for those exposures that are going to take place in the next 12 months.
The company's growing to go from 25 to 50 vehicles, and you have an account. Right. Like you guys are taking on double the risk for no more money.
Right. And I think most carriers that we have, the relationships with, understand that, we know what we know right now, and we don't have a crystal ball, and things can change with what the insured does. But it does take some massaging at renewal if the exposures are up dramatically and they're, essentially.
Yeah, that makes sense.
So I would just say, to answer your question, just trying to paint the picture the best way we can. Stuff like telematics right now is, if you have a fleet, I think if 5, 6, 7 years ago, certain technologies were not readily available and not really expected. Yep. And now kind of the norm.
And cost prohibitive. Like a lot of those telematic companies now are much cheaper and a lot more effective, and you do a lot of training around them. So like dash cams are important. Telematics are like, is that expected now? Like is that a major ding if they don't have that?
I don't play in the world of primary auto all that often. But it definitely, I would say, is, it speaks to the account in its entirety, right? If you have an owner that isn't willing to invest in something that's going to help them and help their insurer potentially get out of wrongful claims, then what else does that say about the account, right?
Yeah,
so
it's like how you do anything is how you do everything kind of thing.
That's kind of the way I look at it.
That makes sense. Okay, cool. What else? What's some like one more piece, maybe on like a different line that you feel like would be beneficial for, like, let's say a construction company. We just brought on a large plumbing contractor, and they got like 900 employees, and they They have a big auto fleet. They're getting a really good deal through the Asterisk program.
Hmm.
But like, obviously they're going to have other lines that we need to look at. And so for that account in particular, like what would be some things that will be looked at on the GL side?
Well, I think GL, you're looking your first kind of at least as a wholesaler, you're looking at the class of business, and for something like a plumber, you're already taking out, depending on what the residential versus commercial percentages look like, you may be looking at a very selective kind of cast of characters, right? Like, we're not going to send this to everyone under the sun. We want to be strategic and kind of how we go about that. So I think the class of business is important. And then, because not everyone that wants to write a carpentry contractor wants to write a waterproofer.
Sure.
So, that's step one. And outside of that, trying to evaluate the frequency and severity element of what that class entails, right? So, and figuring out if it's a 900, you said 900 employees.
Yep.
So that type of operation is going to have a lot of different claims, and figuring out, okay, so what's the problem? Is there a problem with the current carrier? Is it something where is it a frequency problem, or is it a severity problem? Are they having, a bunch of claims that are leaky drains, and it's not a big, huge, massive construction defect problem, and it's just a matter of applying the right deductible? Or is it we have other large pops that are happening all the time?
Yeah.
So that comes with kind of the territory of evaluating the risk, figuring out the commercial versus residential exposures look like, and then market selection.
That makes sense. Yeah, the deductible thing, I'm like, we're starting to recognize the value of managing a deductible properly. Like, I think there's a ton of value in doing that the right way, and just like historically what's been going on, like where do you guys actually want to take on risk? Because it is like, insurance is a very, like, you have it or you don't. But that self-insured retention, that deductible, is like you're self-insuring for a portion of it. So how do you manage that? What are you willing to take on? Like, do you have capital to take on a larger deductible? And like, should you do that?
Yeah, the making sure the financials back the idea that you can stomach multiple losses, of that nature. We even have certain accounts that have deductible / retention ag caps. So, the insured knows going in what their maximum payout is to a certain
specific and an aggregate.
Yeah.
That's cool. That's really cool. That seems like a good product. Well, I love it. Brian, thank you for the time, man. I really appreciate it. It was good seeing you. We got to get together soon.
That sounds good, JT.
All right. We'll talk soon.
See you, man. Bye.
Thank you.